want to give you another great video here today. We're talking about a strategy that's dealing with trading options, and we're actually doing a Teaching Thursday video on options. So options, in essence, are just having rights to buy stock and not actually owning the stock. We're going to go over what is known as a straddle play with options. Particularly, investors do this around earnings time, and they try to do this to gauge in order to make money by hedging their bets. So as we mentioned, we're talking about options, and we're going to talk about a strategy called options straddle. And as I said, this is around earnings season. So let's say that you have, Ford Motor Company, and Ford Motor Company is going to release their earnings report. They're going to say how much money they made, how much money they may have lost, what their guidance or expectations are for the upcoming quarters and upcoming year, things like that. Anything that they just may have going on, what their net income is, things like that. So what happens is, let's say Ford is trading at $16 a share, okay? And so it's earnings season. So what happens with earnings season, stocks become very volatile and the price can fluctuate greatly or a little. So what happens is, if you think that the company's going to do well or do bad, it doesn't matter the direction. However, if you think that the stock price is going to suffer drastically, where it's going to have a major change, now sometimes the stock doesn't change that much, but a lot of times during earnings seasons, the stock's price changes greatly, and this is how people make money. So what you can do is, let's say that you think that Ford is going to perform well and the stock price is at $16 a share, but you buy what is known as out of the money and in the money. So in the money means anything that is less than $16 a share. So 15, 14. This is in terms of call options. A call option simply means that you expect the stock price to go up. So anything that is equal or less, or anything that is less than the current stock price, is called in the money, ITM. Now, if the stock price is $16 and you have an option contract at $16 a share, that's called at the money, because you're at the even point. And then anything that's greater than 16 is called out of the money. Okay? So what happens is, this is out of the money, OTM. So what happens is, if you think that, here's a stock price at $16 a share, and let's say that option contract costs you $50 if you buy at the money. Well, if you buy in the money, you're already buying. This is how stock options work at corporations. If you buy in the money, let's say you buy an option contract at $14 a share, you already made $2 a share. So what's going to happen? This premium is going to cost you a little bit more. So let's say that's $100. And at 15, let's say that's $75. Because you're paying a premium to get a discounted price on that share. Because as soon as you buy those shares, you automatically made money. If you think about it, this is $1 less. That means if you buy 100 shares at this price, you automatically made $100 and you paid 75. So you made 25. This one is $2 extra. So for 200 shares, that's $200. You paid 100 to make 200, so you really made $100 off rip. That's just the way the options work. However, out of the money is riskier because you're looking to pay a higher price for a stock that's actually cheaper. So what happens? These contracts cost less. So let's say that's $25 and 18 is $15. So what happens at earnings season? You're gonna take a risk. You're gonna say, I'm gonna buy some call options. Remember we said call options mean you expect the stock price to go up. So I'm going to buy call options at $17 per share because you expect the stock price to go up. Well, if the stock price is at 16, so you're actually paying $1 extra for a stock that's cheaper. So that's why this contract is going to be cheaper. However, it's earnings season. You think that the company is going to do well. So what happens? The company does well. The stock price goes up to $17. What happens? This $25 premium increases, and now this $25 might be worth to $50, and all these prices go up. Because now, if you have rights to buy it at $14 a share, but the stock is at $17, you're going to make $3 automatically. If you have rights at $50 a share and you buy it at $17, you already made $2 already. So this is the reason that these prices will continue to go up here, and that's how people make money during earnings seasons with options. But what happens is with the straddle, you can do what is hedging your bets. So what you'll do is you can actually, let's go ahead and get rid of these over here. So so remember, that's in the money, this is at the money, and this is out of the money. So what you'll do is you'll say, I don't really know if forward stock price is going to go up or going to go down, but I know it's going to make a big change. All you need to know is you think that it's going to make a big change for whatever reason. So you're going to hedge your bets. You're going to buy call options. So you're going to buy calls at $16, but you're also going to buy puts. And put simply means that you expect the stock price to go down. So if you buy puts at $16 a share and the stock drops to $14, you made money. If you buy calls at $16 a share and the stock price goes up, you made money. So what happens is you know the stock price is going to go down or it's going to go up, but you just don't know which direction. So what you do is you buy calls and you buy puts. Now, let's say you buy calls and puts, and let's just say for teaching purposes, each one is $10. So you buy a contract for $10 in calls and a contract for $10 in puts. So you spend 20 bucks. Now what happens is, let's say the stock price, boom, they do well, it jumps up to $18. Well, what happens is your call price, this price might jump to, let's say, 100 bucks. But now that this went up, your puts aren't worth anything now. So what's going to happen is, now the puts, this cost you $10, this might have dropped down. Now it might be worth nothing and it's $0. So what happens is you lost $10 over here, but you just made $90 over here, and that's going to be offset to be you just made 80 bucks by doing an options straddle. And the same thing can go in the opposite direction. Let's say you bought the puts and let's say the stock actually goes down to $14. Well, now these $10 puts might be worth $100 at 16 bucks. But the calls might be worth nothing, and now that's $0, and the same thing just happened. So regardless if the stock price went up or it went down, it made a major change in one direction or the other, and you hedged your bet. But because the increase in profit for the call or the put, depending upon which direction it went, is far greater than the opposite call or put that's, offsetting it. So like we said, if the stock price goes up, your call is going to make so much more money than you're going to lose on the puts. You win. And the same thing goes in the opposite direction. If the stock price goes down drastically, your puts are going to make so much money that the calls don't matter because the loss is so little compared to the gain on the puts. That's how an option straddle works in option playing, and it particularly happens around earnings because that's when the stock price is most likely to change drastically. Now, it could happen with any other news, but this is just a strategy that option traders will use. And like I said, it's a way to, you're looking at the bigger picture. You're looking at the gain is going to be more than the loss, and that's the way an option straddle works.